What's up guys, Ben here and welcome to Motivation to Invest. Seth Klarman is a billionaire investor and one of the world's most successful hedge fund managers. His investment firm Baupost has beat the market and returned an average of 19% since 1983. Seth has been dubbed the next Warren Buffett as he embraces the principles of classic value investing. However, where Seth Klarman differs from Warren Buffett is that Seth Klarman has actually been buying stocks during the latest 2020 market crash, rather than Buffett, who's just been holding onto a lot of cash. Seth has actually invested over $300 million into stocks such as Google and Facebook. So in this video, I'm going to reveal Seth Klarman's top 10 rules of value investing success. Without further ado, let's dive in. Welcome back guys to Motivation to Invest. Before we get started, go ahead, smash that like button for the YouTube algorithm. That allows us to continue creating more great content like this for you guys. In addition, if you would like more investment tips and exclusive stock market picks, which I personally have invested into, then you should definitely subscribe to this channel. Be sure to turn the notification bell on, that way you'll get notified when a great stock is at a great price. So that being said, let's get into the video. Kicking off at rule number 10, understand and start with managing risk. Psychological studies have shown that the pain of losing money is actually a lot higher than the pleasure of gaining money. So managing risk is vital. In fact, the pain of losing money can actually blur your thinking, and mathematically, it's harder to regain money once lost. For example, if you had an investment worth $100 and it went up by 10%, it would be worth $110. However, if it dropped by 10% to put the investment at $90 and then went up by 10%, you would only have $99. Thus, a 10% loss requires an 11% gain to recover to the starting point. Now, this doesn't seem like a big issue, but it can really start to compound. The math of percentages shows that as losses get larger, the return necessary to recover to the break even increases at a much faster rate. So if we increase that loss to 25%, it takes a 33% gain to get back to break even. At a 50% loss, you require 100% gain to recover, and an 80% loss, you require 500% gains to get back to where your initial investment started. This is why managing risk is vital. Risk is the probability of losing money and the amount you will lose. Great investor Ray Dalio looks for low risk, high return assets, not high risk, high return. And as Seth Klarman says, volatility is not risk. So just because a stock is very volatile does not mean it's more risky.
Our approach is built on three underlying pillars. One is that, as Graham says, you want to focus on risk before you focus on return. Some of that comes from the worrying that George described in his introduction. A lot of it is focused on multiple scenarios. What can go wrong? How much can you lose? We don't think of risk in an academic sense of beta, which doesn't make any sense to us at all. Volatility is not risk. Volatility is volatility. Volatility creates opportunities and isn't necessarily risk at all unless you absolutely needed to sell the day that the price was very low. Rather, risk is the probability of losing and how much you can lose if you lose. So we focus on risk before we focus on return. That's obviously very different from Wall Street, where they still, even after pressure, write a huge percentage of research reports that are bullish, very few that are bearish, and even when they do think about other scenarios, they tend to oversimplify with single point estimates rather than a range of possible outcomes. And in other words, inevitably are focused mostly on how much you can make, and with a spurious precision.
Current rule number 9, invest, don't speculate. One of the major principles of value investing is to actually invest and not speculate. Now this may sound like common sense, but it's not so common. As the great investor Warren Buffett says, price is what you pay, value is what you get. You must understand that every stock has a speculative component. This could be a positive speculation or a negative speculation. For example, with Tesla stock, there is a lot of positive speculation and a lot of bullish analysts. Some analysts have even predicted Tesla's stock to go to above $4,000 per share. At the moment, Tesla's share price has skyrocketed to over $1,000, despite only recently becoming profitable. Analysing the discounted cash flow, this software has valued Tesla at $737 per share. The price is currently at $1,127 per share, with some analysts even placing a price target of over $5,000 per share. Now, just because a company is overvalued doesn't mean it won't be able to reach higher than those figures and you can't make money. You can, but for every dollar you pay over its fair value, the risk of loss increases. As the great Warren Buffett says, it's better to buy a great company at a fair price than a fair company at a great price. So look for great prices on great companies. This brings me neatly onto rule number 8. Invest with a margin of safety. If you invest below the stock's fair value, then the difference between the stock's value and its price gives you a margin of safety. This helps to protect you if your initial analysis was wrong, or also just from bad luck. An example of when I used a margin of safety in my investments was when I invested into Barclays, the UK banking stock, a couple of months back. According to the software, Barclays was trading at 55% below its calculated fair value. That's a 55% margin of safety. In addition, if I compared Barclays to other banking stocks, such as Lloyds and RBS, shares in these two companies were dealing at a price to tangible book value of 0.6 and 0.4, whereas Barclays' ratio is just 0.25. This meant it was a great value stock. On to rule number 7, be a contrarian. In order to find these opportunities where the market is inefficient on pricing, you have to be a contrarian. So what is a contrarian? Well, a contrarian is an independent thinker who observes the masses and does the opposite. Don't follow the herd of sheep. Be the wolf on the outside who watches the sheep's movements. For example, during the 2020 stock market crash, oil prices went negative and many people were selling oil stocks and running away. So I took a contrarian approach to this situation. I analysed the long-term prospects governing oil prices and the best companies involved in the industry. As the great Peter Lynch says, invest in the best companies in an industry with bad sentiment. I then invested into Shell, BP and Chevron, 3 of the largest and most well-diversified oil companies with very low debt. In just 4 weeks, I made a profit of over 60%. So in other words, if you had invested £10,000, you would have made £6,000 in just 4 weeks. Now, it is risky to be a contrarian from an egotistical and even a factual point of view. Sometimes the crowd is right. So what you need to do is analyse things a little bit deeper. If the crowd is thinking short term, you need to have a long-term perspective on the situation. For example, during the successful oil investments which I made, it was clear that oil was going through a bad time in the short term due to excess supply and lack of demand. This caused prices to plummet. However, I knew in the long term that this would not destroy the oil industry forever, and we would still need oil for our cars, planes, and energy. The likelihood that small, highly leveraged oil companies going out of business was high, but the likelihood of large, giant, low debt, well-diversified oil companies going out of business was low. So they were the businesses which I invested into. One of the world's greatest investors, Carl Icahn, has a favourite poem. It's called If by Rudyard Kipling. It says, if you can keep your head while everyone around you is losing theirs, damn, you'll be a great man. This brings me neatly onto rule number 6, know the Mr. Market analogy. Benjamin Graham, the father of value investing, has a great analogy to describe the stock market. Imagine you have a bipolar neighbour. Each morning he either wakes up very optimistic or very depressed. So every time he wakes up in the morning, if he's woke up on the wrong side of the bed, he'll knock on your house and give you a quote on your property. Now let's say your property, you know from analysing the fundamentals of location, the design of the house, the square footage, etc. You get a fair value that your house is worth, say, £100,000 or $100,000. Yeah? Mr. Market knocks on, in the morning, he's woke up on the wrong side of the bed, and he offers you $50,000. He panics, he says the world's about to end, there's a crisis, there's crazy stuff going on, and he offers you $50,000 and hopes you'll sell. You don't have to sell to him. And in fact, you ignore him. But if he knocks on the next day and he offers you, say, you know your house is worth $100,000 and he offers you $200,000. He says, oh, the world's great, the world's amazing, I've had a fantastic day, property prices are going to go to the moon, I will offer you $200,000. Then if you wanted to sell, you could sell to him at that price. So the idea is to observe Mr. Market, but you don't always have to do business with him. Just because the market quotes that a business is terrible doesn't mean the business is terrible. You need to analyze the fundamentals and find its true value. In the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine. So in the short term, it's heavily dependent upon popularity and sentiment, whereas in the long term, it's dependent on fundamentals, revenue increases, net income, low debt, etc. This brings me neatly onto rule number 5, be patient for opportunities. So I know what you're saying. You're saying, Ben, that all sounds great, but what if there are no opportunities to buy and everything seems overpriced? Well, then you just wait patiently. The great investor Howard Marks believes the market moves in cycles. It goes from being heavily over-optimistic to over-pessimistic. So if it's overextended in one direction, in time it will rebound to the other direction. You must sell to the optimists and buy from the pessimists. Volatility equals opportunity. So wait for that volatility. This could be negative news. This could be a bad earnings quarter. If you've got a long-term vision on the business and you know it's a great business, then if you see a little bit of negative news and you know it will not affect the business fundamentals, then that is a great opportunity to buy. Facebook's Cambridge Analytica scandal was a great example. That was a perfect time to buy Facebook stock. During that scandal in 2018, the share price of Facebook dropped to $133 per share. Today, it's worth over $237. On to rule number 4, don't be afraid to average down. Let's say you've analysed a stock and you understand its fair value is $100 per share. It drops to $90 per share, so you purchase the stock. You've given yourself a margin of safety and you've got yourself a great deal. However, let's say in the short term, the stock plummets even more. Emotionally, you need to keep yourself in check and understand that this isn't so bad. Although it may seem bad, it may seem like you're losing money, this actually presents more buying opportunities for you. So let's say the stock drops to $50 per share, then that is actually a time to actually buy more. As long as you've analysed the reason for this dip and you understand if it's just market volatility or has something seriously affected the business fundamentals. If the business is still the same and just a little bit of negative news has caused this price drop, then this is a great time to buy. Counterintuitively, it actually lowers your risk rather than increases it.
We're looking for egregious mispricings. We're not able, I don't feel as talented as Buffett by any means in identifying a great company and buying it at a fair price. And as he has demonstrated, you often just can't find those great companies at a fair price. We're looking for very low risk, high return situations, and that often involves smoking that last few puffs out of a cigar that somebody dropped. The nice thing in today's market is you can buy surprisingly good quality companies or assets and not having to pay up for them.
On to rule number 3, always have a cash cushion. Always have a cash cushion or rainy day fund and never invest any money which you can't afford to lose. For example, Seth Klarman manages over $30 billion in assets. He has 25% of this in cash. This cash is useful to deploy on market opportunities and also if any of his investors need to take out funds. On to rule number 2, be a bottom-up, not a top-down investor. A top-down investor looks at economic high-level factors such as GDP growth, inflation, interest rates, and industry growth trends. An example top-down fund is that of ARK Invest's Innovation ETF, which looks at trends in robotics, 3D printing, and even genetics. It looks for when economists have predicted growth in these industries and thus invest in businesses related to them. Whereas a bottom-up approach starts with looking at each business independently. Is it a great business? Does it have a competitive advantage? Does it have great cash flow? Does it have low debt? And then it looks at the economic factors to see how that could help the business. On to rule number 1, surprisingly, Seth Klarman advocates not over diversifying. Diversification is great as it splits your investment across multiple stocks, thus lowering your risk. However, as you become better at analysing the stock market and analysing stocks, if you know a company is exceptional and it is at an exceptional price, then why diversify across 20 which you don't know as well? So a good suggestion by Benjamin Graham is to not invest in more than 10 to 15 stocks, as you can only keep track of so many. Know these companies very well and invest in them at the right times. Now, I personally have fallen foul to this and am over diversified at the moment. However, when new opportunities arise, I will rebalance my portfolio into my core holdings of my favourite companies. And now for a special bonus clip, use quantitative and qualitative analysis. In other words, don't just look at the mathematical formulas.
Classic principle that Graham espoused is the net working capital test, where he said that if you can buy a stock for less than 2/3 of its net working capital, which is working capital minus all liabilities, that would be a real bargain. And the reason it's a bargain is you're basically buying that business for less than you could liquidate it for. And that's a critically important principle. It didn't mean you'd actually liquidate the business, but it meant that if you wanted to liquidate the business, or if someone else wanted to come along and liquidate the business, that you had essentially a risk-free opportunity to invest in that company because you could get out with a profit. And that if the business turned around, or the market perceived that it was about to turn around, you would then make money without actually ever needing to take control or to cause it to liquidate. That principle was very relevant in the 1930s when there were a lot of stocks during that awful period in the economy trading down below liquidation value. Then for most of the time in the last 75 years, there weren't so many periods where that actually was applicable. If you applied that test, as I said, like 2 or 3 years ago, you would have found almost nothing that fit. And now, once again, there are stocks trading down towards cash per share, below working capital per share. So again, that test might be applicable. Now, I'm not in favor of a paint-by-numbers approach to value investing, where you just follow a few simple mathematical rules and start buying. My understanding of value investing from reading a lot about the studies that have been done is that value investing adds 1 to 2% a year. So if you just mathematically bought the cheaper half of the market and avoided the more expensive half under whatever metrics you wanted, under price to earnings, price to cash flow, dividend yield, price to book, that you would add 1% or 2% a year. But I also thought, why would you ever trust a dumb, blind formula when you perhaps could do better with your own analysis and investigation? So I always thought, well, you can tell that some situations that look superficially cheap aren't that cheap. The inventories are obsolete, the receivables are uncollectible, there are bad assets on the books, there's off-balance sheet liabilities like environmental problems or litigation. So the thought for my firm's perspective was that we'd always follow value principles but try to improve on them through in-depth fundamental analysis and detailed research.
And now for a second bonus clip, have heroes.
Sure. Buffett and Munger would obviously be up there. There are many kinds of managers that I admire, and they do different things. In terms of a plain long-only manager, I think highly of the folks at FPA Crescent, Bob Rodriguez. He was just in Barron's, I think. I have very high regard for people like Paul Singer, like David Abrams, who used to work with me. On a long-short basis, which is not something we do, but is something we think is valid. Somebody like Steve Mandel, somebody like Brookside, the Bain Capital subsidiary.
Which of Seth Klarman's value investing principles resonated the most with you? Comment your thoughts below and I'll join in the discussion. In addition, if you enjoyed this video, go ahead, smash that like button for the YouTube algorithm. And if you'd like more stock market investing tips and exclusive stock picks, which I personally have invested into, then you should definitely subscribe to this channel. And with that being said, I will see you guys on the next video. Invest safe.